Welcome to the podcast. We're diving into the key announcements shaping Canada and the GTA's financial future, focusing on major economic data and policy shifts. I'm Nico, James-Bock, founder of the CondoWiz Group and real estate broker with Keller Williams Co-Elevation Realty in Toronto. This episode of helping you build wealth through real estate brick by brick breaks down the November federal budget, the Bank of Canada's interest rate strategy, the October employment report, new immigration targets, and the latest real estate stats. We're navigating a period of great and intense trade uncertainty, especially with the US, which has significantly influenced Ottawa's shift towards fiscal stimulus and building domestic capacity. Keep an eye on the inflation rate on November 17th and the next major interest rate decision on December the 10th. Deficit doubled and investment focus. The 2025 budget projects a large $78.3 billion deficit, nearly double last year's forecast, attributing the increase to trade uncertainty and new spending priorities. Massive capital spending. Well, the budget commits to generational investments, including $25 billion for housing, $30 billion for for defense, and $115 billion for infrastructure over the next 5 years. Productivity measures. To counter an anemic economic picture, the government is introducing a productivity super deduction and new capital cost allowances for manufacturing LNG equipment. Fiscal restraint and reform. The plan aims for $60 billion in total savings revenues over 5 years and will see a reduction of about 40,000 public service positions by 2028-2029. Current rate and outlook. Well, the Bank of Canada has cut the benchmark overnight rate to 2.25%, seeing it as the right level to keep inflation near 2% while the economy adjusts to structural issues. End of easing cycle? The economists suggest the 2.25% rate may be the low end of the interest rate neutral range and could signal the end of the current cutting cycle. Focus on fiscal policy. Governor Macklem has indicated that the Bank of Canada will leave closing the output gap to fiscal policy, the budget, rather than relying on aggressive monetary cuts. Recent relief? Well, the Bank of Canada has provided 9 interest rate cuts since June 2024, amounting to 275 basis points of relief, though the full impact takes 12 to 24 months. Keep that in mind. Real estate market stats for October 2025. Toronto remains the epicenter for price fragility, with the condo sector being particularly hampered by overbuilding and immigration slowdowns. Remember, we have a record number of completions in 2025. Sales activity versus prices. While sales activity has rebounded 36% from the spring lows, prices continue to face downward pressure due to elevated inventory and cautious buyer sentiment. The average selling price in Toronto dropped 5.2% year over year to $969,700. Condos saw the sharpest drop, falling 7% to $571,500. Long-term drivers. Long-term market strength is tied to future demand and policy levers driving triple-digit price gains historically, but in the present, affordability remains the greatest challenge. Employment and immigration stats. The labor force survey showed a stronger than expected net employment gain of $66,600 or 66,600 jobs in October, causing the jobless rate to dip from 7.1% to 6.9%. Mixed quality of jobs. The October increase was driven primarily by part-time work, more than 85,000 positions, though private sector employment did see its first increase since June. Strong job gains were seen in wholesale trade, transportation warehousing, and culture recreation. Employment in construction declined by 15,000 units. The government plans to dramatically reduce the target for new temporary resident admissions from 673,650 in 2025 down to 385,000 in 2026 to ease pressure on housing. Structural productivity crisis. Canada is facing a structural productivity crisis, a decade-long issue, with the economy not generating enough output per worker hour. The unsettling U.S. attitude towards the free trade agreement is the primary risk factor, creating uncertainty that holds back investment. The BOC has opted for a less restrictive policy, 2.25%, but the fiscal stimulus in the federal budget is expected to take considerable time to impact the overall economy. Canada maintains a AAA rating and the lowest net debt to GDP ratio among the G7, providing a strong fiscal foundation for bold, nation-building investments. The key takeaways: massive fiscal investment, capital spending, is the chosen tool to spur growth, while monetary policy, i.e. rates, is likely on hold until early next year. The big trade-off? The new immigration policy sharply cuts temporary residence to address housing strains, which will stress sectors like construction and potentially worsen long-term labor shortages. The real estate outlook? The housing market, particularly in the GTA, will remain soft and price fragile in the near term due to high inventory, which will take a while to filter through, and cautious buyers. Next steps? The market will closely watch the inflation rate data on November 17th, and particularly the December 10th Bank of Canada interest rate decision. This is the last and final decision for 2025. This episode reveals that while Ottawa is betting big on long-term fiscal stimulus to fuel generational growth, the immediate market reality, like falling prices, suggests investors must remain disciplined. The true measure of success will be whether this capital injection can overcome near-term affordability concerns and trade uncertainty to stabilize real estate values by early next year. Therefore, stay tuned for the December 10th Bank of Canada decision and future inflation data, as these will be critical indicators of whether policy is truly bridging the gap between national ambition and local market performance. If you found this information useful, then like this podcast and or leave a comment. Please share this episode with anyone who may find the content useful. Ciao.